Well, happy Saturday, happy weekend. In any way, shape, or form, you are listening to us, the Real Money Pros. Happy to be here. And I do view this as it is a pleasure to do this on weekends. You know, it's when I talk to people and they're like, man, you got to go do a live radio show every Saturday. I'm like, no, I enjoy it. You get to explore theater of the mind. You get to really recap maybe the past week or things that are topical and happening with the market. And we can give solid advice to maybe someone who has an issue or a thought or maybe some complex thing, or maybe it's simple. I mean, and like I've said before, what we do on the radio complements what we do. And what do? Well, Nick and I, Jeremiah Bates, Nick Daniels, we are fiduciary financial advisors. This is a money program. We are a sponsor-driven program. We are here to guide, not here to sell. So there's no direct incentive. There's no direct incentive for us, right? Meaning it's how we can spread a good message. We can provide education, and the more education that investors have, and I don't want to just pigeonhole it just to investing. I mean, really navigating anything through your financial picture, whether it's estate planning, tax planning, that's a big one. I mean, all these various components of what represent your wants, your wishes, safety, security, maybe all these are a source of anxiety. Hopefully we are removing the anxiety by providing education, because you know the inner workings, and hopefully you have some analogies where you're like, aha, now I get it. Because if there's one thing our industry, the financial advising world, if you will, and especially historically, and I do think this tide's changing a little bit, and obviously people have more access to information so they can do their own research. However, this industry has done a really good job of trying to make things sound so confusing and so complex that you need someone that can explain it to you, because I'll never understand that. That is not the case. We want to arm you with education and information so you feel really confident about the decisions or the actions that you are maybe hesitant to make, or maybe that you haven't thought of. Now, you could add on top of that where, okay, maybe there's some more nuances to this that couldn't be covered in a radio program because, hey, we're limited to segments, and, we only have so much broadcasting time, even though we're here for 3 hours, but you get the point. Well, that's where you can reach out to us, go to the Real Money Pros and say, hey, I heard you talking about this, or I heard you talking about that, or this applies to me. Maybe we can have a longer conversation that specifically revolves around my situation. Perfect. That is the incentive that we have. But there's a lot of great financial programs out there, and why I maybe put us towards the top is that we're live. You can interact with us. 979-59-MONEY. That is the phone line. Again, it's 979-596-6639. You can also send a text message to that number as well. Obviously, Nick and I are going to cover lots of things today, but if you want to change the topic, fair game. Interesting happenings in the market this week, some notable earnings that came through from some notable companies, to the likes of Tesla, to the likes of Google, parent company of Google, which is Alphabet. You had some interesting figures released from Intel, which has been on a tear this past year, by the way. Obviously a part of that AI semiconductor chip space, building out the infrastructure, meaning the hardware to power these technologies that companies and individuals are so optimistic about. But it's really interesting to see Intel. And let's not forget that the U.S., they invested a few $1 billion. I think it was about close to $9 billion. I think there's close to 10% ownership of the United States government in that company. And there's probably some interesting thoughts, but we'll set that to the side. Some just interesting pivots that we've seen in the market. Obviously, conflict in Iran. We had oil over $100 per barrel. Why is that important? Well, that's going to directly affect a lot of things. When you look at price at the pump, you look at airlines, you look at airline stocks, they got beat up pretty bad. I think it was Thursday, saw a little bit of a rally, but meaning you can look at these as opportunities. You don't necessarily always need to look at these dark looming clouds that are over the market that causes volatility and causes emotional behavior in the market, which, by the way, those emotions that are in the market, the human behavior in the market, is how you get gains. It's how you grow your money. It's that risk-reward relationship. If you want a reward, you have to be willing to take on risk. So that is an oversimplification, though. But again, that is appropriate to look at, because then you could say, okay, if there's risk in the market, if there's risk with investing your money, the next logical way to view this is, how do you mitigate risk? Like, how do you mitigate market risk? And there's a bunch of different ways you could do. You could do more tactical moves, and that's just a fancy way to say of, how you're allocating your assets, making sure you have a good balance, right? Or maybe you're doing some types of options, you have some stops, and you're doing those types of things. Yeah, that's totally fine. But what it really comes down to is understanding your situation, understanding the market is volatile for a reason. That's how we get growth. But my big takeaway is these points of volatility that we've seen, and hopefully we always see, is that the disciplined investor is who gets rewarded, where you can set a strategy, follow said strategy, and again, within that strategy, we need to know that there's going to be some movements in your investments. They could go up, they could go down, they could pay dividends. Maybe that dividend is cut. Maybe you have an alternative investment that then is now, they went public, so now your private shares are now turned to public shares, so now the cash flow changes. I mean, it's how this whole thing comes together. But what I do want to point out, though, is that we've seen some very big gains in a very concentrated piece of the market, meaning just a few, really the technology sector, and a few companies to like a Microns, your SanDisks. I do find it interesting, NVIDIA lagging a little bit. It's been the high flyer, and obviously it's still done well, but when you compare it, I guess, this year to, let's say, your Microns, your Intels, your SanDisk, your AMDs, it's been lagging a little bit. But the point being, lots of concentration in those. So it should not be to anyone's surprise if we see some volatility to the downside, and obviously there's also volatility to the upside, but if we see some volatility to the downside, it's largely going to be isolated to that sector where we've just seen huge gains.
Yeah, I think, when you're talking about volatility and all the things that we've been seeing over the last week and even throughout this year, I just think of how it is your best friend if you keep your emotions out. I've seen this. I've said this so many I don't remember when I first heard it, but when I heard it, it was one of those things that stuck, right? So I say it often, both here on the radio and in the office with clients. Emotions are incredible servants, but they make terrible masters, right? If you think about that, date night is better because you have emotions. A sunset is beautiful because you have emotions. Your favorite song is your favorite song because you have emotions. And they enhance life tremendously. But where emotions do not belong is in your investing, right? Because when like the talking heads are saying, oh, the sky is falling, the market is seeing this, the market is saying that. If you set your emotions to the wayside and you're a disciplined investor and you say, well, this is where my mind went today specifically. Let's say you are disciplined at dollar cost averaging, right? Every single month you are putting $500 a month into a Roth, and maybe you're putting like $500 a month on the same day every month into a non-qualified account, for an example, okay? But if you're a disciplined investor, you're doing that dollar cost averaging and you're paying attention and you hear, the markets have slid 3% today. Hey, maybe you normally invest your dollars on like the 30th of every month, but if you hear that things slipped 3% today, you can be like, oh no, this is a great opportunity to put cash to work. That volatility is my friend. Let me do it right now. I don't know. That's just where my mind was going when we were talking about that, because that's like discipline equals freedom.
It does. It's a great book, by the way.
Yeah. That's not a credit to me. I didn't come up with that. But no, discipline equals freedom. We see that all the time with the clients that we work with people that, will call in with their questions. They, the most successful people that we see and have the opportunity to work with, and honestly, I feel like make the most powerful impact in their lives by bringing what we know about the markets and investing alongside of the discipline that they've already been living with, is that financial discipline leads to incredible freedom in that second season of life once you've cut that corporate cord.
Now, it's easy for us to say, yes, be disciplined. And yes, there's volatility. There's so much more. And one thing that we want to dive into is not just assets that are in the form of, let's say, the stock market, meaning a publicly traded asset that has a lot of volatility. let's look at something that for many individuals, especially when you look at the numbers over 65, about maybe $250,000 to $300,000 of equity that you can tap into. How to do that effectively and how to make it work. We'll be right back. Welcome back to the Real Money Pros. We are live. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Give us a call, send us a text message, any topic you want to cover, fair game. I'm Jeremiah Bates. He is Nick Daniels. We are the Real Money Pros, fiduciary financial advisors here for you. Visit therealmoneypros.com. It's where you can access our podcast, previous shows, our educational content, our YouTube videos, sign up for our newsletter, get access to our sponsors. And if there's one thing that I can confidently say, and I say this probably every weekend, is that good financial decisions do not happen by accident. And on the flip side, bad financial decisions usually don't happen by accident either. So you're largely trying to navigate, what does retirement look like? How do I handle my tax obligations? How do I handle business decisions? Maybe it's a liquidity event you're looking to sell. Really, it's just clarity around the entirety of your financial picture. I mean, let's add estate planning in that as well. Having the right guidance matters. If you want to get connected with a fiduciary financial advisor who can help you navigate these waters, visit therealmoneypros.com, click on Find an Advisor tab, and we'll help you get connected with an advisor within the Apollo Wealth Management Network, and we're across the country. We'll find someone who is a good fit for your situation. So again, that is therealmoneypros.com.
Jeremiah, you mentioned, like different things that people are navigating, and it just jog my memory. I've got some clients I'm working with right now. They own a small business, and one of the goals is to build it to the point where they can sell it, and they're willing to keep working in it if need be, but the ultimate goal is to build this to a point where it has a valuation that they could sell it, and they're kind of like got their fingers crossed for early retirement, right? That'd be like having their cake and eating it too type scenario. And one of the things that we're in the process of doing right now is partnering with, I'm partnering the client with a group that does business evaluations, because I'm like, listen, how do you know if you're there? Like, are you there now or not? Now, we have done the math with the client and I, we've done the math saying, basically, if you want X amount of dollars a year to be able to live enjoyably, well, what do we need to have in investments that can be kicking out that sort of income for you, right? We know those numbers, but what they're unclear of is, so then is our business worth that or not? And like and how much is going to be taken out in taxes if we were to sell it now? So one of the things that we said, and about 2 years ago, they had someone come to them offering to buy, and their CPA and myself and the clients, we sat down and just were kind of like saying, hey, man, based on the numbers that they're offering you, like, dude, no, you guys would be worse off to sell, than to just keep 100% control of this right now and keep moving forward, keep grinding and building. Fast forward 2 years later, they asked me again, like, well, how do we know? I said, what you actually need is you need to partner with a company that this is what they do. So they know how to evaluate your business. And then that tells you can look at the offer that you got 2 years ago and what it was valued at. Now you got an actual legitimate business valuation now. And you can say, well, in the last 2 years, if we've covered this distance, that's going to give you a great idea of, all right, I need to grind 2 more years. I need to grind 3 more years, possibly. But at that point, now we're talking numbers that would actually achieve what we're trying to do, this early retirement, if we can sell it. And so the whole thing is like when you're making a decision like that, right? Any sort of decision, the more that you can surround yourself with vetted quality information regarding that topic, the more likely you are to make a really wise decision in that process. And I think many, many times the reason why people don't do that, from conversations that I know that we have in our office, is that A, people don't know where to go to get that information, and that's a legitimate problem. I mean, you can ask ChatGPT, but it's not the same as like, I know somebody who knows somebody that is like really qualified in this, right? And then so A, you don't know where to go, or B, you're just a lot of times like just too embarrassed to ask.
Yeah. Well, on this topic of selling your business, this is why I want to make this very clear, where if you are a business owner, and and maybe you feel like you're getting to that season of life where it's like, all right, I want to take all this sweat equity that I've built in my business, and I want to turn it into, hey, I want to be removed. A big conversation that comes up for, maybe not all, but a good percentage of my self-employed clients that are looking to sell is that it's just the stress. It's just the grind. They're like, we're in our mid 50s. Maybe we got some health concerns, or they maybe had a parent or a close friend that maybe had some weird health curveballs. And then it's like that. Things are kind of brought all together, like in a form of context that they really didn't view it. And it's like, you know what? We're exchanging all our time for these dollars. And obviously there's benefits from the business, but setting all that aside, it's like, hey, we're ready. We want to start making a move. And the reason why I mention that is because it's so important to be proactive with your planning when you are selling a business. And I would argue you would, if you have that thought of, hey, maybe we should sell, it's time to exit, or find a way to really tap into the value of this business. Or maybe you don't even view it that way. It's like, how does a sale even operate? Like, what is even the first step? You probably want to give yourself at least a 2 to 3 year runway. At least a 2 to 3 year runway where you can get a network of professionals that can help, number one, value your business. They're giving you a detached look of, based on the figures, based on the numbers, based on your sector, based on this, based on all these metrics, you can arrive at what is a proper valuation of your business that's actually based on tangible data. But you have that in a point in time, let's say 3 years before you're going to sell. And if that number looks a little low, then okay, what do you need to do within that amount of time to get those numbers to be more attractive? So it gives you that benefit too. But also, let's imagine if those numbers look really good. You're like, hey, that's the mark. That's even beats expectations. Like, I could sell it now. Well, okay, now you know that, so you can start taking that approach. But then you have a plan after the sell. Because here's what will happen logistically is because what's providing your income? You owning the business. What's making your net worth balance sheet grow more? The valuation of your business. So when you sell said business, you got to find a way to replace income. And you got to find a way to still get that growth. And how do those all coordinate in the form of quality of life impact? Meaning, what's your cash flow burn rate? Okay, you were taking advantage of write-offs through your business that are no longer eligible because now you no longer own the business. So now we got to start looking at a proper bucket strategy. How do we start allocating your assets? Because when you sell your business, generally that's going to be in the form of a large lump sum of cash, usually a very attractive number. But the thing is, you can't just move that in a cash account and think, okay, I'm great. I mean, maybe that could be the case, but generally that's not going to be the most prudent approach towards your financial future, especially if you're selling your business maybe mid to later 50s or maybe even early 60s, because you still arguably have 30 plus years of runway that you still got to make that money last. Another important thing to note, and Nick, I'm so glad you brought this up, is having network of professionals in that realm. Meaning, when I'm working with business owners, like, we can look at the numbers. I can give you a rough idea, but I am in no means, way, shape, or form going to be able to give you an effective valuation of your business. I mean, I can give you some thoughts, but I mean, that's not going to be the final number. It's kind of going to be based on just experience that I've had working with other business owners. You want to work with a professional and then have the CPA involved to understand the categorization of how this business sale is actually structured. And then you have the advisor, fiduciary advisors kind of quarterbacking this whole thing and knowing how that's going to coordinate in the whole picture. I'm going to give you 2 examples of a client that literally sold this business about 2 weeks ago that did the proactive planning, and I'm going to give the example of the client that met with me months after they sold their business. Starkly different results. Welcome back to The Real Money Pros. Again, we are live. Phone lines are open, 979-59-MONEY. Send us a text message, 979-596-6639. This is a money show. We are live. Anything you want to chat about? You got estate planning issues. You've maybe inherited an IRA and you're curious on how the rules of withdrawing that IRA affect you from a tax standpoint and making sure you're not penalized. These are topics that you can certainly send our way. And again, you can visit therealmoneypros.com as well. You can send us emails, Jeremiah at The Real Money Pros, Nick, N-I-C, at The Real Money Pros as well. So again, on this topic of these resources that you can accumulate through delayed gratification, and you can look at that through the lens of dumping money into your 401k, putting money into a Roth IRA. saving money in a 529 for your kids' education costs. The examples are abundant. Or you are a business owner and you've been doing your business and you've been growing it, and that business grows value. And maybe now you are attractive for a potential suitor of said business. Or maybe you're thinking, wow, I think it's time. I think it's time to hang up the cleats, as they say, and kind of enter into that next season of life of retirement. So as a business owner, it certainly changes the lens because, and I'm painting with broad brushstrokes, but if you find yourself in this position where your net worth is in your business, which again is fine, because I've met with a household, this is about 6, maybe 7 months ago. They're ready to sell, not quite yet, because really in our conversations, what we arrived as, it's like, there's not a lot of time spent. Your quality of life is actually still really good. You've set up this business to where it's really operating on its own, which is fantastic. That's one of the key marks that you want to hit as far as selling your business, to where if you as the owner leave, does the business leave with you? Meaning, like, does it completely just crater and fall apart because you are the business?
Yeah, no, because that's if you're looking to sell, that's going to increase the valuation greatly if you have that successful transfer of ownership and then it keeps on humming. I mean, let me give you some stats. Like we were talking between the break. I mean, what you're about to speak into regarding business sales is really powerful. I don't want to take away from that, but just some stats for small businesses. An estimated 92% of small businesses, they exit in a permanent closure rather than a successful sale. That's lost equity.
So they just close up shop.
They just close the shop.
It's like the gym you show up to, like you've been training in for years, and you go up and one day it's like, hey, we're closed. It's like, hey, we're liquidating everything. You're like, oh, dang it.
So out of the roughly 500,000 small and medium-sized businesses that exit the market in the U.S. annually, about 5% get sold, 3% are transferred, typically to family members. The other 92%, they simply lock the doors, turn off the lights, and walk away. So that's leaving equity on the table. Now, what are some of the reasons? Typically 70 to 80% of these businesses, they don't have a formal succession plan or exit plan. Owner dependency, which you mentioned. A lot of businesses do close because of unexpected health concerns, which kind of ties into how dependent the business is on the person who owns it and runs it.
Yep.
But that can force a closure. Or another big reason, though, lack of financial clarity. If your books are pretty opaque and vague, good luck enticing somebody to buy it.
Well, that's a big reason why I bring up that 3-year runway, because let's imagine that you've been operating as your business, things are going great, and all of a sudden you get an offer shot across your bow. Like, hey, we'd like to buy your business. You're like, wait, what? Okay, I never thought of it, but now let's really consider this. And I've seen this a lot. So again, bear with us, paint broad brushstrokes. We're not saying every business owner is bad at books, right? But a lot of times we've seen it where there's some gaps or there's some cleanup that needs to be done. So again, if you start considering this and you started, let's say this plan started January 1, 2026, great. And then you can use 2026 to really start getting that cleaned up, because especially if you have outdated books or things have been a mess and it's been year over year over year over year of that trend, you're not going to be able to clean it up in 1 month. It's going to take some time. And again, because when you have a suitor come to purchase your business, that is what they're going to look at. They're approaching your business because they see the opportunity that's there. But now they need to do the due diligence. Now you're going to sign that NDA to let them kind of go in and start looking at everything. Look at your tax returns. Look at your EBITDA. What is actually flowing in? What are legit expenses? What are expenses that would carry on? All of those types of things. And if it's not tied down, that could become a problem. But that's why that 3-year runway gives you a little bit of room. But again, once you enter into that realm of like, okay, we're doing this, we're going to figure this out, we're going to get this sold, that business valuation is extremely important. And I want to bring this back to, because one thing that I've seen that I have a lot of concerns with is where there isn't really a separation of advice that you're getting, meaning you're getting advice on all components of the business sale from one place. Which, okay, if that one place has experts under its umbrella, whether it's around the business valuation, they have experience in business sales, so they can look at things from like a legal lens. So I mean, the attorney side of things, the valuation side of things, that a lot of times should be separate. Not like meaning unless you have like a unicorn of a person, not saying they don't exist, but meaning getting that valuation and getting that to make sure the legal side of things are buttoned up. And then you have, Nick, I think where a lot of times we step in is, what does this business sale actually mean? Mm-hmm. Like, okay, imagine this. The business sale is done. You get a large check, and then maybe you're going to get some residual checks maybe for 3 years, right? And then maybe they keep you on as a consultant, just throwing out these ideas. Like, how does this all work? How do we make our financial engine continue to run now that it's a completely different form? I mean, you were driving a giant shipping barge for maybe 2 decades, and now you're in a speedboat, right? It's like that takes a whole different approach on how you're sailing that thing or motoring that thing, of like how you're parking it. I mean, the analogies can go on, right? I'll spare you the continued analogies, but you get the point. So you get that, you're getting that advice. And then you're getting the tax advice from the tax professional of understanding, how is the business sale going to be booked? What other options are available for deferred taxes? And then getting the tax analysis. So you're getting this holistic view of actually of all the logistics that'll happen with your business sale. And where I've seen, not that it falls apart, but just so many chips were left on the table. And a prime example of this is I met with someone where their CPA was giving them all the advice. And I'm not saying they were a bad CPA.
Okay, but wait, I want you to clarify. When you say the CPA was giving them all of the advice, specify all of the advice.
Well, I mean, the valuation side of things, which again, I think a competent tax professional or CPA that has experience in business transactions, and maybe it's not a complicated sale. Okay, I'll give the benefit of the doubt on that, right? So that could be okay.
So the CPA is advising on the price that they should sell their business for.
Price that they should sell the business for.
Next detail.
And then meaning locked in, and then what the taxation of the sale is going to be. So they already did this all this planning. So this is going to bring it back to the point of 2 different examples. This is someone that I met with that already sold. So meaning they sold, the deal was done, and then they came and met and said, hey, here's what happened. It's like, okay, well, okay, nothing's falling apart, right? But let's just, the fact that it happened in the same calendar year, let's really start exploring some strategy. There's some things that we could look at. We could look at doing some individual 401ks. We could look at doing a cash balance plan on top of that, which gives us even more pre-tax deferral. Maybe we could look at doing, because you wanted to start another consulting business. Maybe there's an opportunity to buy a commercial building that would give you accelerated depreciation, meaning that business sale took place this year. This arguably is going to be the biggest tax year that they will see for the rest of their lives. Yeah. So in the next year, it's going to fall off, meaning huge tax year for this year. In the next upcoming years, it's going to fall off a cliff. So we need to find, every low piece of hanging fruit that we can find for tax savings, because you're talking about significant money that's going to be left in your pocket. So again, no, we can't do that. The CPA already calculated the tax bogey. I'm like, okay, just because he figured out the taxes that you owe doesn't mean that we're executing the best ideas that's going to save you in taxes. And the CPA is also going to give us advice on how to invest the money. Like, meaning it's one person that, and again, I'm not knocking the CPA, but again, just from the business seller side, it would behoove you to have a coordinated approach of like, okay, let's maximize tax savings. Let's maximize the investment plan, that should be geared behind a dialed in financial plan in retirement when it comes to cash flow, when it comes to your goals, needs, how are you going to coordinate Social Security, how are you going to coordinate this continued consulting work, how is your spouse going to continue to work? I mean, these are all kept in here. Now on the flip side, real quick, I have a client that we've been talking about their business sale for 3 years, and that actually took place, signed, done about 2 weeks ago. And we know we've already coordinated the CPA. We already know the tax obligations. We already know the landing spots for all the money. We've already done the cash flow planning, and all of our assumptions were based on a lower valuation. And the valuation came in higher. So it was just starkly different from the person who sold, then met. It was kind of like, they're just kind of treading water, like, dude, what do I do now? Versus the other person where we had that runway to plan, they are nothing but smiles, no stress. And I asked him, I was like, are you stressed out? How do you feel? He's like, no, we've already done all the plan. Like, this is all going according to plan, and if not better according to plan. So it's just a stark difference between the two. That forecasting and planning is paramount. We'll be right back. Welcome back to The Real Money Pros. Again, we are live. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Visit therealmoneypros.com. Again, good financial decisions don't happen by accident. If you want someone in your corner that can help you navigate, listen, maybe you're a business owner, you're looking to sell. Maybe you're not looking to sell, but it's, hey, how do I look at the liability of my business? How do I look at adding in employee benefits, like a 401k, simple IRA? Should I do a SEP IRA? I don't have employees, and now I have employees. How do I need to navigate these waters? How do I actually properly look at my business as an asset versus just collecting a paycheck? That's an important thing to note. And that stat that you hit on, Nick, was pretty interesting around the fact that, I mean, a lot of business just close the doors.
Yeah, on average, about 92% of small businesses, the exit is they lock the doors, they turn off the lights, never to be seen again, versus actually taking an asset that could have some value. I mean, think about this. Like, even if you had to spend $3,000 to get an accurate business evaluation, and it comes out that, yeah, someone would be willing to buy your business for $100,000 versus just locking the doors and walking away, like, wouldn't you rather, even if there's going to be some taxes, like, wouldn't you rather pocket something for all of those years of sweat and labor and toil versus just, I'm done?
Great point. And I think it's interesting because I've had some self-employed folks that I've met with where they seem a little downtrodden, the fact that they haven't put a lot of money in retirement accounts, and they look at it's like, oh, there's not very much in there, and it's like, no, I mean, that's fine, because and you kind of show them the numbers and you show them kind of the trajectory of like what I'm like, no, you need to look at this through the right lens. Like, your business is an asset, right? I mean, just like your Roth IRA owns assets, or your traditional IRA, your 401k has assets. They're just in a form of a mutual fund or an index fund or an ETF or a stock. Your business is an asset, and just like the stock market, your stock is worth what someone's willing to pay for it, right?
Correct.
Now, the dynamics are a little different because it's just a bigger market. It's liquid. There's market makers. I mean, there's the whole plumbing side of the stock market. But if you look at your business, yeah, there likely will be someone that will put a value on it. They'll be willing to purchase your business, aka asset, from you. And so, meaning if you're in that same boat where you look at, I'm just so far behind the game. I met with a couple, self-employed. They're maybe about 2 years from selling their business, and the one spouse is like, "No, we're fine. We're fine because if we're not saving retirement accounts because our business is our retirement." I'm like, "You're not wrong." And then the other spouse is like, "No, yes, I get that, but we should be adding more money to these other various retirement accounts because you don't know what had happened in the business. What if this happens? What if that happens?" I'm like, "You're not wrong either." It's like, no, I can't disagree with either approach, but when it looks, we had a caller, but it looks like they dropped. But when you look at that approach, you just look at it through the right lens. And as a business owner, it is important to look at that, have that forecasting of what is the end game, because it's easy to get caught up, staring at the tree and losing sight of the forest that's behind you. So again, there's some moving parts to this. If you are a business owner, and I don't know the stat, I know we talked about this a few weeks ago, but there's going to be a huge transition of small business ownership, because I mean the stats are quite staggering when you look at this aging baby boomer generation, and the percentage of small businesses that they own within the United States. They're gonna want to find transition plans. They're gonna want to find exit plans to how to get it to the right suitor or to the next generation.
My best friend, he lives in a suburb of Birmingham, Alabama, and he and his wife inherited her parents' HVAC business. All right. Now, if you've never been into the South, let me tell you, an HVAC business can be very lucrative. It is hotter than hot in the summertime because of the humidity down there. It can be colder than cold. It's crazy, and it's hot a lot of the year, right? So they inherited this business when her parents both passed away, but while they worked in the business for her parents, they were handcuffed into working a certain way, right? Because They didn't control the business. They didn't own the business. And the dad, like, he had his way of doing it, and he saw it as one thing. It was kind of an antiquated way of like seeing it, and not open to like growing and evaluating where is our lowest impact, highest profit coming from in this business. Now that they're both in charge, they are looking at through that lens. What is low impact, high profit? What is what's high impact, high profit? And let's focus on those things that can actually grow our business, because in the Birmingham metro area, there are like small independent HVAC businesses getting bought up like crazy, and that's what they're looking at. They're in their mid to late 40s, saying, okay, here's our game plan. We are investing in this business to grow it, because this will be a vehicle that will facilitate retirement if we strategize correctly. I mean, that's how you have to look at it.
Yeah, I mean, you can like I said before, you can look at your business as just a paycheck, or you can look at it as an asset that you are building value in for a future exit date. And it's not uncommon. I mean, I've seen this in the I don't know if mom and pop shop's the right word, but it's the best I can come up with right now. But the mom and pop auto shops. Right?
Yeah,
it's like been there for 20, 30, over 2 decades, and they sell. It's like they have a process, they have employees. I mean, you're seeing a lot of that. You're seeing mom and pop vet clinics. You're seeing that too. So meaning there's a lot of money out there that wants to flow somewhere. And what we've seen an acceleration of this, and maybe it's other, it's like a consolidation. You could say it's private equity or these bigger, these larger corporate conglomerates that want to go and diversify and help fortify that out, because they feel that they can operate at a higher level and there's going to be a better net return. But then this is also flips on the other side, where if you're looking at, hey, maybe I want to cut the corporate cord and I do in fact want to be a business owner. I mean, when you look at, again, the statistics of this transition of business ownership by this aging generation, there's certainly going to be opportunities there. And entrepreneurship, I've seen it a few different times or many different times, and it's not for the faint of heart. I had a couple clients where they were in a steady corporate role, and then they pivoted, and one is he wanted to do they wanted to open up their own spa, like they're like a med spa kind of speak, okay. Right?
Yeah.
And he's like, I never did this. And he's like, I was in a big corporate company for years and years, and his spouse was working for another spa. And it's like, I'm going to jump all in. I'm going in. So they did. They're 2 years in, and they're absolutely crushing it. They're expanding it. They're getting new locations. I mean, we're involved in the conversations, great conversations with the CPA. I mean, anytime he comes to a pivotal point of saying, okay, I want to expand. Here's this other building. It's going to be a bigger cost. Like, how do we look at all this? Great. Let's dive into the numbers. And then we dive into it. We make sure that we're still tracking, because, again, there's a point in still growing the business, but we don't want to lose sight of, hey, the impact that's going to have on just your standard household quality of life. Let's make sure we maintain that balance. Let's look at a proper form of leverage, meaning taking on some debt.
Yep.
And again, for those of you out there, debt doesn't always need to be looked as a burden. It can be looked at as an actual opportunity. I mean, if you look at the real definition of leverage, it's just controlling more with less. So how do you effectively incorporate that? How do you include the insurance side of things? But it's conversations that we consistently have to make sure that it's cash flowing. As you grow, you don't get over your skis, because there is you can bet on the come line, but there's that risk reward. If we're only looking at the reward, we got to make sure that we properly look at the risk. And I know we talked about, I guess the intention was not to talk about business ownership and entrepreneurship and how to properly look at a business sale, but those are things to consider when you're in the thick of it. Are you collecting a paycheck, or are you actually building value? It should probably be a combination of both, because when you get to a point where you want to exit, like real estate agents, it's a prime example. It's like if you have an existing book, it doesn't mean like, okay, I don't want to be a real estate agent anymore. I'm just kind of closing the doors, so to speak. It's like, no, you have contacts lists. You have something of value that could be attractive to someone else. So again, for all those business owners out there, if you are looking at, you like the conversation and you think, well, taxes, exit strategy, Haven't thought about that?
What do I do with the cash once I sell?
Go to therealmoneypros.com. Get in contact with us. We have experience. We have advisors across the nation who have experience in this. We got to take a break. First hour's done. We'll be right back with hour number 2. Stay with us. Excuse me. Cat got my tongue. Welcome back to The Real Money Pros, hour number 2 of our 3-hour live program. This is a money show. We're here to talk about anything in your financial picture. You want to talk about taxes. You want to talk about estate planning. You want to talk about retirement planning. You want to talk about how donor advised funds work, because we had a call. I want to jump into that. Charitable gifting, business transactions. You want to talk about investing, what stocks you feel good about, what sectors or technologies you feel good about. Interesting. Hey, anytime headlines hit the market, like, we want to talk about it, right? But generally speaking, is this like a stock talk show where we're going to dive into, Tesla's quarterly earnings report and what the market reaction was based on their free net cash flow of rolling through? No, because generally speaking, when you're following an investment strategy, a point in time earnings report for one quarter in that particular year, which arguably is looking at numbers in the review mirror and then getting some kind of forecast the company's giving of its forward-looking guidance. Sometimes you can put more weight on that versus others. But generally, if you look at that sector as a whole, I mean, you can have really good companies that may have a faltering earnings report, right? And when you look at what the market, like if you look at actually the price of a stock, the stock market's it's a discounting mechanism, meaning a stock price is based on what the future earnings / profitability of that company is anticipated to be. So sometimes if you have a company that has missed its earnings mark or hit the earnings mark, but when they forecast the remainder of the year or they forecast a year out and they're like, actually, we're going to be spending a little bit more money. Or
That's where I was going with what we saw this week.
Yeah, we're going to be spending a little bit more money than anticipated. Or, like one thing too, it's like to the likes of Alphabet, which is parent company of Google. When you look at Meta, parent company of Facebook, you look at Amazon, you look at, you could put SpaceX in this. I mean, just a lot of these companies that are tied to this, the anticipation of returns from fortifying their AI. At some point, and there's a lot of enthusiasm around that, and obviously that's why we've seen some big gains in the market. But at some point, Wall Street is going to maybe lose some patience of like, okay, you're spending $1 billion per year on this AI technology. At what point are we going to see that actually translate into making the company more efficient, which then translates into profitability, right?
Yeah.
I'm not saying we're there yet, but it's just an interesting part that paying attention to. But what I do find interesting, I'm just kind of going on a little side tangent here, especially when you look at Tesla, it's no longer just how is the order for the cars, the sales for how is that looking? It's like, no, you have the electric vehicles, obviously the Cyber trucks and the Model S and all that, Model E, Model Y, and then you have the AI component, you have the robo-taxi component, you have the self-driving car component, which I guess you could argue is a part of the robo-taxi, and you also have the humanoid robot component. So there's a lot of moving parts in there that as far as to digest of these various technologies that are on one umbrella of Tesla. But you also look at Tesla, it's historically been volatile. There's been big swings to the up and the down, but that's really that's kind of how the market operates. And that's when you look at these individual companies, if you own an individual stock, you could be subject to more of those swings. And not saying that it's right or wrong, it's just something that's to be anticipated. So when you're developing your investment thesis or strategy, you're prepared for that, and you're not making and we talked about emotions involved in investment decisions. Understanding that going in, and that's why I think it's really important to understand the why behind your investing your dollars. And I don't care what it's in. I mean, it can be in a rental property, it could be in a individual stock, it could be in a fund. Like, what is the purpose of why you're doing this?
Yeah, my mind goes to two examples of this. In my early days as an advisor, I helped a young couple just open up Roth IRAs, and they were doing like $50 a month each into their Roth IRAs. And I felt so good, new in the business, and I'm helping them make good tax moves because one day, compounding over time, they're going to have a great Roth IRA that's going to really help them out when they hit retirement. And I was talking to them at like 6 months after they'd opened it and been funding it. Okay, so like each account had, $300 in it, I think. And they're like, yeah, we haven't really seen much growth on it. Like we've put $300 in it and our accounts are worth like $308. Like, I guess I need to re-explain, or maybe I didn't set expectations correctly at the beginning. But these are going to go up and down. Like just because you put $50 into it, like it's not going to magically turn into $600 in 3 months. Like you got to ride the ebbs and the flows of the market. It's something that we're doing for a long time. And you're going to see that whether you're in an index fund or whether you're in an individual stock. And I would say, like, to your point regarding Tesla, you're going to see far bigger swings if you're in certain sectors on individual stocks versus index funds. So there was that. And then, like, you made this point, Jeremiah, of like, why are you investing in this in the first place? Are you investing because you want to see like rapid, crazy growth? Are you investing in this because you just want like a decent dividend yield? Are you investing in this for the point of, maybe you just want to own it for a year, 2 years, make 10, make 15%, and then turn around and sell it? My daughter is in the horse industry. She wants me to invest with her and her boyfriend in horses. Yeah. She wants me to like help them buy a 2-year-old horse that's started, train it. They're going to train it. They're going to show it. And if it shows well, then obviously it becomes a more desirable horse. And then at like 3 or 4 years of age, they can then sell it for more money because they've groomed it, trained it, made it a more valuable horse within this realm of the industry. And I look at that and I'm like, horses have to eat every day. They have to be watered every day. They have to be checked on by vets constantly. All I see is a money pit. I'm like, no. I don't want to buy a horse as an investment.
Well, I mean, not to say, because I mean, on the counter argument against this, to maybe anyone who listens, like, Nick, you don't understand the horse business because actually it could be quite profitable. I have a client she's a horse broker. So I mean, she basically she wheels and deals horses. It used to be her full time. Like her business was really ramped up. I mean, she's more of in her retirement years, kind of scaling back. So she doesn't do it full time. She just mostly does it because inevitably an opportunity pops up. She can't just, it's in her nature to do it. Like she'll be walking in the grocery store and it's like, there's an opportunity of like a horse to be able to broker. Yeah. It's just like one of those situations, but that can be, I mean, she makes good money, even with the lack of time that she spends in doing this. And I know this isn't apples to apples, a little bit different, right? But again, you could almost look at that as kind of like through the investment lens where she's going. It's like, okay, it's probably for more, I want to say retail use, but that's not, or maybe like personal use of just someone who just wants to own horses. Like maybe not like, they're not going to race them. They're not going to, because I know your daughter, the form in which she's in, it's like more of like showing, right?
Show horses. They're called reiners. Here's my thing. Like, and they're already on their third horse that they are flipping. Essentially, they're horse flipping. Right?
Yeah.
Okay. They're already on their third horse. It's been profitable the first 2 times, right? And they're kind of working their way up. Here's my concern, though. About a month ago, I get a text from my daughter, and she says, basically, she says, hey, cross your fingers, our horse just got injured.
Yeah, that's a big issue too.
Like horses don't seem to come back from injuries like our athletes, like our human athletes do. I'm probably wrong, so you can email me at nick@therealmoneypros and you can correct me. But in my mind, if a horse gets injured, it becomes a bottle of glue and there is no return on investment. And I'm like, no. But if I buy a stock, if I buy a stock, an individual stock, and there's a bad earnings report one quarter and I lose some value on that, like, hey, I can still hang on to that. There's time for that company to recover, right? There's time to recover from that. There's not necessarily recovering from a horse that like blows out a tendon or something like that. That's my reluctance in investing in the horse industry.
Hey, well said, and I appreciate your analysis on that potential investment and knowing your why behind it. Again, phone lines are open. We're live, 979-59-MONEY. That is 979-596-6639. We're up against a break, but when we come back, we had a caller last hour. The call dropped, but we gathered enough information. It's around how do I bring down this tax bogey? Because I recognized about a $600,000 gain. We'll talk about that when we come back. Welcome back to The Real Money Pros. Again, we are live. Phone lines are open, 979-59-MONEY. You can send us a text message as well, 979-596-6639. Visit therealmoneypros.com. Good financial decisions do not happen by accident. Navigating retirement, taxes, business decisions. Just getting more clarity around your financial present and your financial future. What we can all agree on is having the right guidance matters. And that is what we are here to do as the Real Money Pros. We are fiduciary financial advisors. We are not here to sell. We are here to guide. We are a sponsor-driven program. But again, back to guidance. If you want to get connected with a fiduciary advisor who can help you, visit therealmoneypros.com, click on Find an Advisor tab, and we'll help you get connected with an Apollon advisor who's a good fit for your situation. We have a great network of fiduciary advisors that are across the country, and we would love to get you coordinated so we can start getting some answers or some strategies in place for you. Speaking of strategies, we had a phone call at the last hour. The connection was a little spotty, so unfortunately we couldn't get it on air. However, our producer Josh was able to glean some information, so I think we can put together some of the puzzle pieces here. So it was a caller out of Portland. The question was in regards to a DAF, otherwise known as a donor-advised fund, and how to potentially utilize that to his advantage because he was going to experience a $600,000 capital gain in this year. Okay, this is not too uncommon when we talk about years where, maybe it was a highly appreciated piece of real estate. Maybe it was, the list could go on. Maybe it was a highly appreciated stock. Maybe it was multiple pieces of real estate. Maybe he sold his business and he's recognizing that gain. But we're going to assume that $600,000 is not going to be in the form of income. It's going to be in the form of a capital gain. And I think it's important to know, not I want to go too far deep down the tax wormhole here, but it's really but I do think these concepts are important to know because, and I don't even want to say this for most individuals, but basically your biggest headwind, your biggest expense that you will have against your outgoing cash flow, like meaning you make money through various sources and then your money's going out. And some of that money is going to pay for your mortgage. Someone's going to pay for your gas. Someone's going to pay for clothes. Like it pay for a vacation. We get it. But the biggest number that you'll run into over your lifetime is taxes.
Oh, for sure.
It's just a part of the gig. So when we look at this categorization of how your income is taxed, it's important to note because you have what's called gross income, and you could refer to as adjusted gross income, modified adjusted gross income. I won't get into the specifics of that, but basically the difference between AGI and MAGI is MAGI adds back some of those tax-free items that you would get. They add it back into MAGI. So your MAGI could, in fact, be higher or lower. But bottom line is you have your gross income. What amounts to your gross income is, well, did you make wages? Like, do you have a job? Does your spouse have a job? Do you have Social Security? Do you have rental property income? Do you have dividend income from an investment? Those items will be subject to your ordinary income rates and perhaps your state income tax, meaning not all of your sources of income that are included in your gross income are going to be taxed the same. You have some sources of income that are going to be taxed at ordinary income rates, and then you're going to have some levels of income that are going to be taxed at capital gains rates. And capital gains, or capital losses for that matter, that's going to be subject to either short-term or long-term capital gains rates, and that is going to be subject to either 0%, 15%, or 20%, okay? So we just want to make sure we understand how is the income received, what tax is it subject to. then we can look at, okay, what options are available to decrease said tax bogey? And I think we're going to be able to cover some of this and some of that because we got another caller that I want to dive into. So we have John calling out of Ventura, California. John, what can we do for you?
Yes. I appreciate your show, guys. And I was wondering how do, and what maybe are some ideas that you guys might have about tax arbitrage and how companies could benefit from this and the employees could benefit from a tax arbitrage.
Maybe dive in a little bit deeper, John. When you say tax arbitrage, like what are the things that come to mind for you? And it doesn't need to be in the form of a said strategy, but just like the sentiment across that.
There are different programs that are offered to companies for tax incentives through tax arbitrage that companies aren't taking advantage of. And some companies do, but some companies don't. And so if more companies were to get a hold of somebody like yourself that understood this, they could help with the overall income to each employee as well as with their overall money back to the company on an annual basis.
Oh, John, 100%. I agree with you. I mean, and that landscape of, whether we want to call it tax arbitrage or tax savings, when you are a business, I mean, and it could be a larger business with multiple employees, it could be a C Corp, it could be an S Corp, or it could be maybe just a partnership, or maybe it's a smaller business where it's two spouses that own the business that have a few employees. I mean, what you're talking about, that really applies to all these types of businesses. And if you think about this on a simplified level, in my opinion, is that if you save on taxes, that means that it is more money in your pocket to do what with? Well, then when you're looking at the business, maybe that's going to be in the form of increasing employee wages. Maybe that's going to be in the form of more research and development expenses to grow said business. Maybe it's going to be in the form of expanding. Maybe it's going to be buying another building or enter into another building. Meaning the options that are then available they just grow so tremendously. So, but what it really comes down to is what tax options and what tax strategies or what tax arbitrage is available. And if there's one thing that, I will say this, like the tax tail can only wag the dog so much. Like meaning not every decision can be made of just saying, how can I save just, save money in taxes? Because sometimes the time, the energy, the resources that are used, sometimes that actually translates into negligible tax savings. And sometimes it could be small moves that have a much greater impact from a tax standpoint. So again, I'm a huge fan of the sentiment that you're bringing across, but it really comes down to like the answer depends on the business, what it's into, like how is it structured? Because I'll say this, like one thing is for the per the big beautiful bill, there's several tax saving provisions, and one of the biggest ones for small businesses is the return of, meaning 100% bonus depreciation. In most cases, if you buy certain qualifying assets, like let's remove the business, let's just look at a single family rental. You buy a single family rental, and that will be on a depreciation schedule. So even though you are getting, let's say, a certain dollar amount as far as economic impact to your household, doesn't mean that all of that's going to be subject to taxes because you get that depreciation benefit. Well, for small businesses, if it's a qualifying business asset, you can immediately deduct 100% of that cost in 1 year versus doing that over several years. And that could apply to new and used equipment. You can do, there's 179 deductions. You have immediate R&D, research and experimental costs that you can recognize in 1 year. So again, I'm a huge fan of tax triage. We got to take a break. We'll be right back. And welcome back to the Real Money Pros. We are live. Phone lines are open, and the text line is open as well. Feel free to send us a text message, or if you want to get on air, ask us some questions. Maybe you got a mess. Maybe you got some ideas, some thoughts, some questions. You want to change the topic. Fair game. 979-59 money. That is 979-596-66. 888-848-3739. John, certainly appreciate the call. I mean, and when you talk about this idea of like, hey, should businesses and how can businesses benefit from tax arbitrage? And, the term arbitrage, I just look at it as like, hey, like how can businesses be cognizant or aware of the tax savings that are available to them and to make them more efficient? And then more efficient, that could translate into my mind of just giving so much more flexibility to the business. Maybe it gives them the ability to hire more employees. Maybe it gives them the ability to expand or, whatever the case is, right? Or maybe it's more beneficial to the business owner. And it all just comes down to like how, the business owners, how is the business structured? But, Nick, you and I were talking during the break. It's like, yeah, we love that idea. That's how, many small business owners that we work with, 9 times out of 10, we're going to find some cool tax savings ideas that'll even come in the first meeting. Like, Nick, you were mentioning even just going to an S-Corp filing.
Yeah, do you want to recognize all of your income as W-2 wages? Or do you want to have some of your income basically the taxes on it cut in half because you're not paying all of the Social Security and FICA on it? That kind of sounds nice to a lot of business owners when they're like, wait a minute. I don't have to recognize everything as W-2? No, you don't have to recognize everything as W-2. So, that's an example of it. I think the other thing that you can do is I think you have to ask yourself though, depending upon the type of business that you have, whatever widgets you build, sell, or, whatever, how is it geographically? Or if you're just within one state operating, say you're a remodeler and you have a remodeling company in the state of Oregon, probably not a lot of other tax arbitrage you can do other than is your business structured correctly? You know what I'm saying? It's not like you have a multi-state company where your headquarters is here, but most of your revenue's made there, yada, yada.
Well, so many things hit the headlines too of these huge corporations, these trillion-dollar companies, and it's like they don't pay their fair share. And it's like, if you really looked at it. But a lot of those tax savings provisions or those little carve-outs in our tax code that really benefit, they're there for companies. They are. In my experience, the most lateral movements you can make as far as tax planning is when you are self-employed, you own a business, maybe you directly or via a partnership. And I kind of want to bring this up because I have a client, and this is what we talked about a lot this in the first hour of selling said business, how you're building the equity and how you can look at that through a potential sale. I have a client who's self-employed, makes good income, but he's kind of at the point he's like, I got nothing to sell. He's like, I don't. I think he might be a little. I think he probably could, but at least in his eyes, he's not treating his business as far as building this mass amount of equity. It's basically him. He's providing a service. He's got maybe 1 or 2 employees. They provide a service. They make they all make good income. But he set it up to where he understands that, okay, if at the end, when this is all said and done, he's relatively young, so he's still probably got a couple decades at least to be able to operate his business. And things could change. You never know. But in his case, it's just, hey, he doesn't need a building. He doesn't need a bunch of equipment. He's just providing a service because he's an expert in what he does. And he's got a few employees. So him understanding that the odds of him having some big liquidity event to then supplement his retirement through a business sale, the odds of that are pretty slim. So we have to then say, okay, we need to start deferring money to prepare yourself, just like as if you were a W-2 employee. It's
sure.
Which is great. You're making, and to be clear, I worked with a number of W-2 employees who they crush it. They do all the right things. They do the delayed gratification. They have the cash flow plan, the goals place plan. They have the savings plan. They have the investment plan. All of it coordinates together. So when they eventually pull the corporate cord, cut the corporate cord, they're sailing off into the sunset. They're extremely happy. They're calm. Money is not a source of stress. It's a source of peace, of really enjoying now that they have this time left to not being bogged down by clocking in, right? So in this case, yeah, self-employed, and then we bring it back to John of these tax efficiencies. That's when you can look at, okay, how do we set up these employer plans? Either maybe it's a SEP IRA, which is basically a pension that you're setting up for yourself, even though it operates like a lot like an IRA. Stands for Simplified Employer Pension. Maybe you do a simple IRA because you have employees and you don't want to deal with the high cost of running a traditional 401k when you have employees. Oh, I don't have employees. It's just me and maybe it's my spouse and the rest are 1099 contractors. Great. Let's look at doing what's called individual/solo 401ks. It gives you all the cool provisions of a normal 401k, but it's not as cost prohibitive because you don't need these other parties involved because the maintenance and compliance is just a bit of a beast to manage. Maybe you're looking at doing a cash balance plan. Cash balance plan can coordinate with your 401k, which allows you to do it in a significant amount of pre-tax dollars on top of your normal 401k contributions. Well, that's great. I'm doing all that, but I can't put any money in a Roth because I make too much money. Oh, did you know that you can structure your 401k in a way? Now, I'm painting with broad brushstrokes here, but again, a lot of times you can structure your 401k that will allow you to do what's called the mega backdoor Roths, meaning you can put more money in your 401k. You're not only subject to the employee deferral limits into a 401k when you're self-employed. You could do a contribution as employee. But remember, you're the business owner, so maybe you can do a profit share contribution from the company into the 401k. And then there's another categorization of money that you could potentially put in your 401k, again, if it's structured right, where you can do what's called after-tax dollars. Now, you don't get a tax benefit on that, but you can convert those after-tax dollars into a Roth IRA that likely will far exceed above and beyond the $7,500 Roth limit that you are subject to right now. So whether it's the S Corp or how you structure your business of how it's viewed from the IRS, and then also all the qualified accounts that you can tie to your business. These are all ways that you can be extremely efficient from a tax standpoint at the business level. And then we already talked about, there's been some cool provisions in the Big Beautiful Bill, whether it's 100% accelerated depreciation in that same year, it needs to be a qualifying asset. Those are just a few examples. I would argue we're barely scratching the surface of things that arguably should be considered and should be looked at when you're self-employed. So again, John, appreciate the call. Phone lines are open, 979-59-MONEY. You can send us a text message, 979-596-6639. I want to bring it back to that other caller that we were talking about before John called. So really the sentiment, what we're getting behind is they had a question around a donor-advised fund and how that can be used to offset the $600,000 capital gain that they would recognize this year. We don't know what that capital gain was received from because the connection broke. But what I was explaining is that it's important to understand that how you receive your income is going to determine how it's actually going to flow through on your tax return, which means how is it actually going to be taxed. We want to dial that in. And then once that's dialed in, then we can look at tax savings opportunities. This caller brought up a DAF, aka a donor-advised fund.
Right. So what is a donor-advised fund? How does it work? Well, basically, think about this. If you're very charitable-minded and you're looking for a tax deduction, it is an investment account that you are contributing to. Say you've got highly appreciated stock, or you want to put cash in it, but you want to fund this account. Once that stock or that cash is in that account, you control the account, but you no longer benefit from it. And that's an important distinction. And
when we say donor advised fund, like, I know that could sound kind of like, donor advised, like I have to establish a fund. It's not that complicated. Like,
no.
It's almost as simple as opening up like a traditional IRA or a Roth IRA. It really is just
it's an account.
It's an account.
It's an account. The title is fund, but it really is simply an account. So let's just say you've got 600,000, like let's say it's an individual stock, and if you were to sell that individual stock, you're going to recognize a $600,000 capital gain, right? But if you donate that stock into your donor advised fund, which is simply an investment account that you are donating to, you control it, but now you're no longer benefiting it. The immediate benefit of contributing to this donor advised fund is the immediate tax deduction for you. Right? So if that asset was valued at $600,000, you've got that deduction that you're putting into that fund. Now, once it's in that fund, you can liquidate that position. So you don't want to hold that individual stock any longer. What you want to do is sell that stock. Now you're not recognizing that $600,000 capital gain because you donated it into this fund, but you're charitably minded and you want to create $600,000 of cash, or then reinvest it and then use it to fund multiple charities if you're charitably minded. I mean, it can be your local humane society, it can be whatever, as long as it's qualifying.
Tied to a church.
Yeah, 501c3. But then you have control of where the money goes to benefit charities, but you're just no longer benefiting from that account personally once you get that tax deduction. It's really simple and easy to set up and do.
Easy to maintain, easy to structure, and there are significant tax benefits with that under the assumption. And that assumption we're going to talk about when we come back. Stay with us. We are back. This is The Real Money Pros. Visit therealmoneypros.com, one of the best ways to interact with the show. Again, good financial decisions do not happen by accident. So listen, if you're navigating retirement, taxes, investing, business decisions, if you want clarity around your financial future, having the right guidance matters. Someone in your corner who's experienced that can help you navigate these waters. If you want to get connected to a fiduciary financial advisor within the Apollon Wealth Advisor Network, and we're across the country, visit therealmoneypros.com, click on Find an Advisor tab, and we'll get you connected with an advisor who's a good fit for your situation. Again, we are live. Phone lines are open, 979-59-MONEY. That is 979-596-6639. Give us a call, send us a text message. And again, realmoneypros.com. It's where you can sign up for our newsletter, get access to our sponsors. We're here to guide, not sell. We are a sponsor-driven program, so we'd appreciate you checking out those sponsors. So, Nick, you and I were talking about that, the question, and the gist of it is person called the program. They're going to recognize about a $600,000 capital gain this year, and they were looking at a donor advised fund as a way to potentially offset the tax bogey. Okay, let's look at these through a couple different lenses. One of which is, yes, a donor advised fund, which again is just an account that you use for your charitable gifting. It's kind of similar to where if you just did a cash donation to a charity, but instead of just doing it to all these charities or this and that, you can sometimes, you could look at it through like this. You could front load your charitable gifting for a very long time, meaning in 1 year. So the year that you actually do the contribution into the donor advised fund, it's going to act as if you did a contribution to that charity directly, right? So when the money goes into the donor advised fund, that's where you get the tax benefit. Now you have the money in that donor advised fund, which you can use immediately or in the future to then do your contributions to these 501c3s. So if you ties to your church or like humane society or whatever the case is, in theory, that would be your charitable gifting designated account.
Right. And inside that account, you can make investments, you can grow that money, and from a tax standpoint, it doesn't matter how much you're growing those investments in there because you're distributing non-taxable charitable donations to all of these organizations that you want to support. So it's a great way for you to get an immediate tax benefit with the potential to carry over in subsequent years.
So a couple important things to note with a donor advised fund or a donor advised fund account. I think I want to start using that account at the end of it, right?
It's helpful.
So if you do a cash donation, meaning if you just move just cash directly into that donor advised fund, you can deduct up to 60% of your AGI. So now let's imagine a scenario where if you did a contribution in 2026 to a donor advised fund, just of cash, just a transfer from your savings account into the donor advised fund, and the amount that you put in there was more than 60% of your AGI in that year, well, you could think in your mind, well, I put more money in there than I could actually deduct. That wasn't very smart. No, not the case, because that deduction, if you have money left over or above and beyond that 60%, like let's imagine you did a cash contribution and ended up being 100% of your AGI. Like you made your AGI was $100,000 and you put $100,000 into the donor advised fund. Well, only $60,000 is going to be able to be deducted off of that first year. The remaining $40,000 that'll carry over into the next year. And generally, you can carry forward those deductions for 5 years. So you're okay, meaning you're okay to fund above and beyond that 60% if you're doing cash. Now we talk about appreciated long-term securities. So this is a strategy that Nick, you and I have used for a lot of our clients who are charitable minded is if you have a highly appreciated stock, you can basically donate the stock, the fair market value of that stock, into that donor advised fund. So whatever the fair market value is, you get that deduction up to 30% of your AGI. So it drops in half. So just to be clear, you don't get this experience, you get 30%, but you don't pay capital gains on that stock sale. So that's some tax efficiency there. But if we bring it back to this caller, the call dropped, so we couldn't really dive into the situation. Yes, on an island on its own, if you're running into a large capital gain in 2026, can you use a donor advised fund to help reduce the taxes that would normally be owed on recognizing that capital gain? The answer is yes. Okay. Now, how much? Well, it just depends on all your other income sources and actually how you're funding it. Okay. So there's that piece. But we also got to really look at the underlying objective here. I have a number of clients who are extremely charitable minded. And when I say charity, like I'm saying like legitimate 501c3s, like meaning they hold that as like their top priority as far as their funding goals, that they want to do this donation, that donation to these various places. Donor advised fund makes a lot of sense because you're already doing that charitable gifting. Let's just find a more efficient way to do that where you get a better impact from a tax standpoint, which again, if you kind of look at this holistically, the more money you're saving on taxes, theoretically gives you more money to fund your charitable endeavors. Okay.
Correct.
So there's that
Correct.
being said. Because you could say, well, the money's going to the charity, so why don't I do all this fancy work just to save taxes on it? Well, that's the reason why, if you really wanted to look at it. But would I suggest you do the donor advised fund? Well, if you're not charitable minded, or if like you're like, I'll ask this question. I'm like, are you charitable minded for prospective clients? Like, yeah, I mean, I'll do maybe a couple thousand, or maybe a few $100s, like, for a few places. But I mean, by no means is it like the top priority.
In other words, it's not really moving the needle.
It's not really moving the needle. So in this case, I mean, hey, if you're already doing significant contributions, or you're looking at your contributions as a percentage of your income, whatever kind of approach you take, then yeah, the donor advised fund account should not be slept on. But if that is not a high priority for you, then why would you take cash or an appreciated security, put it into a fund? I mean, especially a high dollar amount, if you're talking about offsetting a $600,000 gain, if you put a significant dollar amount into a donor advised fund, you just might be overfunding an account that's not, again, Nick, to your point, moving the needle.
Right. So then in that scenario, all right, I'm not charitably minded. I'm looking for other ways to lower my taxable income, and maybe the scenario is, but I also I still need income. I still need benefit from this account, from this investment vehicle. Maybe what you need to consider is a charitable remainder trust. You open up a charitable remainder trust, you fund it. You can possibly defer some immediate capital gains. You can use it to create a steady supplemental income stream for yourself. Okay. The trust can take whatever has been put inside that highly appreciated stock, cash, whatever. It can make tax-free moves with those assets, meaning selling it, reinvesting into different positions. All right. And on an annual basis, a certain percentage of that income being generated or of the growth being generated is coming out of that trust to you as an additional source of retirement income.
Yeah, the CRUT, I mean, again, not knowing a lot of information on the situation, that CRUT could make a lot of sense. And the reason why I bring that up is because I would argue it gives you a little bit more flexibility. Because, Nick, to your point, when you put that money in that donor advised fund account, I mean, it's there. I mean, it's there. Like, you can't be like, oh, I changed my mind and now I want to start taking some income off of it. What the CRUT allows you to do, this charitable remainder trust, is it does have that charitable component on it, but you as the donor, or I guess, the creator of that trust, to be clear, it's irrevocable, so you can't have control over it. Like, you can't just unwind it. There's some rules that you need to pay attention to and make sure you're getting the right advice. You're working with a competent estate planning attorney to make sure that it is covering all your boxes as far as the you want to make sure it's all set up legit. But then as far as the actual functionality and maintenance of it, it's not too complicated. You can still donate a highly appreciated stock, avoid the capital gain. You still get the benefit of the tax benefit of the charitable contribution. And then the big benefit is income off of that. You can draw that off to your benefit. So a little bit more flexibility and a little bit more dynamic than the donor advised fund. But again, both of these are options. So, I mean, it's a great question, and it's a question that should be had. If you recognize a large capital gain, that's great. You recognized it.
Good for you.
It's not about what you earn, it's about what you keep. So the idea of finding these various strategies is let's keep more money in your pocket, but let's make sure that money is not earmarked for something that doesn't benefit you. We got to take a break. We are coming up ready for hour 3. Stay with us.